Hello, and welcome to our first video lecture dealing with Chapter 1. And Chapter 1 deals with financial accounting and business decisions. In this video specifically, we're going to look at forms of business organizations, we're going to look at business activities, we're going to discuss the users of accounting information, and we're also going to talk a little bit about the accounting process as well as GAAP. So after you complete this video, you should be able to explain or describe the forms that a business organization can take. You should be able to identify and explain the business activities. You should be able to identify who the users of accounting information are. And finally, you should be able to explain the accounting process as well as GAAP. So first thing we're going to talk about is the business organization and its three forms. When a business starts, or when a person starts a business, they have a choice. I got a bunch of choices really, but among what am I going to do, who are my customers, the main thing that they need to decide is what legal form or what form is my business organization going to take. They have a choice. There's three of them. A person can decide to make their business a sole proprietorship, or they could say, you know what, I have a friend here who has the same passion as me, got the same great idea, so we're going to go in business together. So that would be a partnership. Or a court or a person can decide, you know what, I think I'm going to incorporate my business. Okay. So let's quickly go through the difference between each of these. Well, sole proprietorship, this is a business that is owned by one person. Okay, only one person owns the business. Sole proprietorships are the most common form of business, or common form of organizational form of a business. The reason why is because pretty much anybody can go into business. All you got to do is hang a shingle and start your business. Now, a partnership is very similar to a sole proprietorship. The only difference is that a partnership requires two or more people for the purposes of conducting business activity. Now, a corporation, this is one of the most costly forms of a business organization. Involves a lot of lawyer fees, things like that. But a corporation basically is a separate legal entity. That means that the corporation is different than its owners. Okay, so under the eyes of the law, we say that the corporation is a legal entity. Okay, it can enter into contracts, it can sign binding contracts. Again, it does that through the CEO and CFO and the managers of the business. But again, it's a legal entity. The owners of a corporation, those are the stockholders. Okay, so a corporation could have one owner. Technically, a sole proprietor could say, you know what, I want to start a business, and I want to have certain advantages, and we'll get into those in a second. But I want to have certain advantages, and I'm going to incorporate my business. Okay, great. So owner sets out, says, I want to incorporate my business. But the only catch is there's only going to be one owner. So that means that one owner has all the stock. Okay. So again, a corporation can have anywhere from one stockholder to 1 million stockholders or 10 million stockholders. The corporation is the dominant organizational type. So let's get into some of the advantages of a sole proprietorship, a partnership, and a corporation. Well, if we're just looking at the sole proprietorship, they have a number of advantages. Number one, they're easy to form, right? All you got to do is hang a shingle and you're a sole proprietorship. They do have certain tax advantages. Okay, we'll get into those in a second. Let's pump the brakes here. We're not going to get into taxes in this course. This is financial accounting. But what we need to know here is that the advantage or the tax advantage that a sole proprietorship has is that the business does not pay any income on its or it doesn't pay any income tax on its net income. What we mean by that is the business is not separate from its owner as a corporation is. In a sole proprietorship, the owner and the I'm making air quotes here, business are one and the same. So what we're saying here is that the business does not pay any taxes. Any income or net income that the company generates, it flows right to that sole proprietor or that one owner, and that owner pays taxes on that income at their tax bracket, or whatever their tax bracket is. That's the amount of taxes that they're going to pay on that business income. Another advantage or benefit, if you will, of a sole proprietorship is that the owner has total control, right? He or she is the only person in the business. That person makes all the decisions. When we're looking at a partnership, again, this is very, very similar to a sole proprietorship. The only difference is there's more than one owner, okay? Advantages of a sole proprietorship, they are relatively easy to form. It's always a good idea if you're going to go into business with somebody else or a group of people that you get a partnership agreement. That partnership agreement specifies who does what and who's responsible for what, who makes the decisions, who's responsible for running the business, who's a silent partner. We're not going to get into too much of that in this class, but just know that it is easy to form. It does have tax advantages. It has the same tax advantages as a sole proprietorship. What that means is any net income that the business generates flows to the owners. So the owners pay income tax on the income of the business, not the business itself, okay? Another advantage of the partnership is that we have a broader skill set, meaning if I go into business for myself and I'm a sole proprietor, I'm limited to the skills that I bring to the table. However, if I form a partnership, let's say I want to own a bakery, okay? Don't ask me why I don't bake. I don't like to bake, but let's just say I start a bakery, okay? My cousin actually, it's a true story, she actually went back to school to get to study culinary arts at IUP. So let's just say me and her want to go into business, right? Well, she brings a totally different skill set to the business than I would. I would bring more of the business accounting knowledge. She would obviously bring the baking knowledge and know how to bake. So that's what we mean when we say that the advantage of a partnership is that it has a broader skill set, okay? A negative or a disadvantage, I guess we should say, to both a sole proprietorship and a partnership is that it is not easy for them to raise capital. And that leads us into our corporation, right? One of the main advantages of a corporation is that corporations can easily raise capital, very easily. We just issue stock. The ownership of a corporation can easily be transferred. If you don't want to be an owner of a corporation, all you have to do is sell the stock. It's very easy. One advantage, and this is probably actually the main advantage of a corporation, is that stockholders have limited liability. Okay, what that means is they are protected against losses that the business incurs. Why? Well, because of the definition of a corporation, we say a corporation is a separate legal entity. Okay, so as a shareholder, I am not personally liable for the debts of that corporation. I am only liable for my investment in the corporation. So if I buy one share of McDonald's stock, okay, I don't know, let's just say it costs $15. If McDonald's goes bankrupt or McDonald's gets sued, my personal assets aren't in danger of being taken in the lawsuit or anything like that. In fact, I'm only liable for my $15 investment in that stock of McDonald's. So again, when we're talking about the corporation, We're just talking about, or I'm sorry, when we're talking about the forms of business organizations, we have three: sole proprietorship, partnership, corporations. We talked about the advantages of each of these, but notice we really didn't talk about the disadvantages. Well, the advantages of a sole proprietorship are, or I'm sorry, let me rephrase that. The disadvantages of a sole proprietorship technically are the advantages of a corporation, right? What do you mean by that? Well, I mean that a sole proprietorship cannot easily raise capital. An ownership can, or a sole proprietorship cannot easily transfer ownership. Okay, so that's what we mean by the disadvantages of a sole proprietorship. Partnership, the same thing, right? Um, Partners cannot easily raise capital. They cannot easily transfer ownership. Okay. Um, the disadvantages of a corporation, well, those would be the advantages of a sole proprietorship. One advantage of a sole proprietorship, well, two actually, is that it's easy to form. Um, the owner has total control, and well, sole proprietorship has tax advantages. Corporation does not. The owner of a corporation does not have total control, right? There's a board of directors. There's a number of owners that own shares in the stock that vote, okay? Um, Corporations are not very easily to establish. Again, you have to get lawyers involved and create articles of incorporation, things like that. Excuse me. In addition, corporations do not have the tax advantages that a partnership and a sole proprietorship do. Okay? So let's go ahead and look at business activities. Now, as we go through this, and we'll add to what you read in the chapter, but once you think about it, it's kind of like information like, yeah, I kind of knew that, right? It's kind of one of those things that, like, hit you in the head, should have had a V8 kind of thing, like, oh yeah, I know that, right? So there's three types of business activities: financing, investing, and operating, right? That makes perfect sense, right? Why? Well, first let's look at the definition of what we mean by financing activities, what we mean by investing activities, and what we mean by operating activities. But once we go through this, you're like, oh yeah, that makes plenty sense. And as we're going through this, think of a business that you're familiar with. McDonald's, Burger King, General Electric, any business that you're familiar with. Okay, so financing activities, right? Basically, what we're saying here is company needs to acquire money to support its operations, right? McDonald's needs to acquire money so they can sell hamburgers and French fries and all that good stuff, right? General Electric needs to acquire money so they can, well, make stuff, right? They can make turbine engines and a bunch of other things, right? So now we're looking at a corporation here now, okay? So how can a corporation specifically finance their operation? Well, they can do it in one of two ways: debt financing or equity financing. Debt financing is basically just borrowing money, right? Borrowing money from creditors. Well, from the corporation standpoint, who are the creditors? Well, just like you or I, they can go to the bank and ask for a loan, or they can go to the general public and they could sell a bond, and they could, sell issues of this bond, and investors would give them cash, and in return, that corporation would pay those investors, or those creditors as we call them, those creditors interest, and at the end of the loan term, or the bond term, they're going to go ahead and give them their principal money back. So basically they're just borrowing money to use. They're being charged a fee, interest, and they're going to repay that money back. Equity financing says, you know what? We're going to take on more owners, meaning we're going to sell stock to investors. Okay? So those are the two main activities, or two main tools, I guess you could say, in the financing activities. Now, investing activities, right? This makes sense. We're not talking about you or I, how we would invest in, invest in a 401k, or we have some extra money in our paycheck, so we'll put it into we'll give it to a financial advisor to invest for us. Here, when we're talking about investing activities, we're talking about the corporation investing in equipment, property, plant, equipment, making purchases of resources that they need in order to run the day-to-day operations. Okay, I don't know why I'm stuck on McDonald's, but let's just go with it. McDonald's, right? They need to invest in fryers, grills. They need to invest in cash registers, right? They need to invest in freezers and refrigerators. They need to invest in inventory, right? So they have buns and hamburgers and chicken and whatever, right? So when we're talking about these investing activities, again, we're acquiring, or the business, the corporation is actually acquiring some land, building, or equipment. In accounting, we call that PP&E, property, plant, and equipment. Okay? Finally, the third business activity we're going to look at is operating activities, right? Well, what are operating activities? Operating activities are the day-to-day activities that a company does in order to either sell a product or to provide a service. Okay, so think of hospitals, right? Hospitals have operating activities, right? Well, what are their operating activities? Well, they're selling health, basically, right? They're somebody comes in with an illness, they're fixing it, right? Or hopefully making that person better. So those operating activities involve, doing surgery, taking x-rays, prescribing medicine, things like that. Let's go back to McDonald's. McDonald's, what are their day-to-day operations? Well, they, got to make, quarter pounders, and they got to make McChicken sandwiches and things like that. Very important. When we're talking about the operating activities, this is the sole reason why the company exists, right? Why does McDonald's exist? To serve food. Why does Burger King exist? To provide food. Why does Target exist? Well, to sell merchandise. Okay. So when we're looking at the business activities here, all of these are really related. Okay, or they're interrelated. Well, what do we mean by that? Well, think about it. The operating activities, those day-to-day actions that a company does to either sell something or make something, right? They need financing activities to do that. So those financing activities hopefully are going to be invested in their day-to-day operations, okay? In addition, those operating activities can go back to financing activities, meaning the cash that we generate from our operating activities, we can use that to pay back financing that we've, the money that we've borrowed, or we can pay dividends to the owners of the stock. When we're looking at operating activities, basically what we're saying here is operating activities and investing activities, those are related, right? How? Well, think about it. We're generating cash by operating, selling hamburgers and doing surgeries and selling merchandise. That cash that we get, well, we can use that to invest in the business, right? We can maybe buy better surgical equipment, or McDonald's can buy better fryers or newer fryers or new grills, whatever. Financing activities and investing activities, those two kind of go hand in hand, right? We're borrowing money, or we're selling equity, or raising capital to invest in our business. We're going to use that to buy PP&E, okay? We're going to take those investing activities that we have, and we're going to use that to generate cash so we can then use it in the financing activities, okay? So second to last thing we're going to look at in this video is, who are the users of accounting information, okay? And we basically have two users. We have external users, we have internal users. External users are people that are external to the company, okay? These are people who need information about our corporation. Investors, I'm pretty sure they would want to know how profitable the company is, um, how well the company's doing. So an investor would be an external user. Regulators, they want to know, um, how well's the company doing, right? They need to know if they need to, increase certain protection acts, the IRS, right? They need to know how much tax to collect from the company. So regulators are another external user. Why? Because they're not inside the company. They don't know what's going on. They need accounting information so they can make decisions, right? And then finally, we have our creditors, right? Why does a creditor want to know about a corporation? Well, they want to know if the company is, first of all, able to pay them back. That's probably the most important. Um, but also, too, if we're another business, let me give you an example. Let's say we own a bakery, okay, and McDonald's approaches us and says, hey, we want to buy buns from you. We want you to be our supplier of bread products, but we want you to extend credit to us, okay? Well, we're a bakery. I mean, obviously, this is a no-brainer. It's McDonald's, right? But as a creditor, as a service provider to this company, I would want to know, should I extend credit to them, right? Well, how can I tell if they're credit worthy, right? Again, those financial statements will help me out. So the creditors are not just the banks and the investors that want to invest in bonds. The creditors are people that basically give loans to the company, whether that's a cash loan, or it's like a product or a service loan. Then we get to internal users. Well, this is kind of a no-brainer because internal users are people that are internal to the company, right? They know what's going on. Management, right? Management needs accounting information. They need to know, hey, how profitable is our, not only our company, but how profitable are specific product lines within our company? How profitable are different divisions of our company? Okay, so definitely management wants to know, or management is definitely an internal user. Human resources department, well, obviously they're an internal user, right? Human resources need to know, how much cash the company has on hand, or um, uh, how much equity the company has, as far as can they justify, are they able to pay a raise to employees. In the finance department, so anybody that you can think of that's internal to the company, they're internal users. Okay. Ethics are kind of a big deal in accounting. If you can think back to 2001, 2002, I believe it was. Can't remember the exact year. It's embarrassing. Enron, all the accounting scandals that happened in the early 2000s, right? Well, basically, they really acted unethically. So ethics, we're talking about the values, rules, what governs our way of life. Okay. A lot of companies have a conduct code, or a code of ethics that help employees to navigate certain situations that maybe might not be, might be a little shady, might be a gray area. So companies do provide, excuse me, companies do provide their employees with a code of ethics, or a conduct code on how to behave and how to conduct themselves as they work within the company, or as their representatives of the company. We're not going to get too much into this, but the AICPA, that's the American Institute of Public Accountants, they also have a professional conduct code of ethics. Unethical behavior, again, not good. What is unethical behavior? Well, basically it's lying, cheating, stealing, and management could, and they have, especially back in the early 2000s, have acted unethically by falsifying financial statements, providing misleading financial information that people use to make decisions. So, back in 2002, the government, Congress, enacted the Sarbanes-Oxley Act of 2002. Okay, and This was written to help curb some of the unethical behavior that businesses were engaging in, as well as to try to restore some investor confidence within the stock market. Okay, so last thing we're going to look at is the accounting process and generally accepted accounting principles. We call that GAAP. So before we go into detail about GAAP, let's look at the accounting process. Well, accountants mainly do three things, right? Three main things. They identify, they record, and they report. Okay? What do you mean by that? And why are you saying that and the slide doesn't match what you're saying? Well, let's think about it. Accountants need to identify relevant economic transactions. Okay? Did the company spend money? Did the company incur an expense? Did the company earn revenue? Okay? So they need to identify that transaction. They need to record it. How do they record it? Well, they quantify the activity. Basically, the receipt has a dollar amount on it, and they record it in a journal or in the accounting records. We call those the books, right? Finally, after they identify and quantify and record, those are kind of two things, they report, right? They have to communicate that information to users of the financial statements, whether they're internal or external, okay? So again, the accounting process, the three main functions that an accountant does is identify, record, and communicate. Okay, so what is GAAP? Well, GAAP stands for, again, Generally Accepted Accounting Principles, and this is the authority or the rules basically of accounting. Okay, GAAP is an authoritative literature, I guess you could say, of what you should be doing. This is how you need to record revenue. This is how you need to record an expense. So basically, it's a set of rules that kind of sets the stage for everybody, meaning all corporations that trade on a financial exchange within the United States. Very important that GAAP only followed by U.S. companies, okay, not foreign companies. Foreign companies have a different reporting rules maker. Okay, so GAAP, which is enforced by FASB, which stands for Financial Accounting Standards Board, FASB, and basically these are the rules that everybody that trades on an exchange, this is what they follow. Okay, it allows us to, I hate the saying, but allows us to compare apples to apples, right? Everybody's recording revenue the same way. Everybody's recognizing expenses the same way. And as investors, we know this, and it allows us to be able to compare and contrast the results of one company from another. Okay. GAAP does change. It did change. It will change. Because there is a group, like I said, FASB, that sits around and basically makes this stuff up, for lack of a better term, okay? In addition to FASB, right, Security and Exchange Commission, they are actually the primary regulators of accounting information, okay? The SEC, because of the Securities and Exchange Act of 1931 and 33, I believe they are, because of the stock market crash of, was it 27? The SEC was formed. The SEC says, okay, we're going to oversee everybody that sells stocks and bonds. Okay, SEC had a lot on their plate, so what they did was they said, okay, you know what, we're going to kind of offload the accounting rules making to FASB. Okay, so FASB actually reports to the Security and Exchange Commission. FASB, again, is not a government entity. Okay, it's made up of industry professionals, academics, academia, I guess you could say, that actually make and establish these pronouncements. Okay, so again, GAAP, even though it's U.S. GAAP, they are not, or FASB is not a government entity, but they are responsible for creating GAAP. Okay, the Public Company Accounting Oversights Board. Those are the people that oversee the auditing standards. We're not going to get into auditing in this class, but there is, if you have an accounting, or if you're an accounting major or a focus in accounting, you will have an auditing class. But basically, the Public Accounting Oversights Board establish auditing standards and create rules for auditing. For our intensive purposes, as long as you know it exists, you're fine. Okay. Then we previously mentioned that, GAP's a big deal. We follow it here in the U.S. Well, what does everybody else follow? Meaning, what do other countries follow? Well, other countries follow IFRS, which is International Financial Reporting Standards, IFRS. Basically, there's a bunch of countries, nations, whatever, who adopt IFRS and who use it. Okay, what IFRS does is it reduces any irregularities in information or reporting. Let's put it that way. Reduces the irregularities of reporting for multinational companies. Okay, so again, how GAAP says everybody in the U.S. follows the same rules, so we can compare apples to apples. IFRS says, you know what, all you other nations out there, specifically 120, we're going to give you some accounting standards rules that you can follow. Okay. IFRS is kind of overseen, if you will, by the International Accounting Standards Board, the IASB. The IASB to these other 120 nations are what FASB is to the United States. Okay, in other words, the IASB formulate these international accounting standards, or IFRS, and go from there. Okay, so that's all we're going to look at in this video. When we come back, we're going to talk about the accounting equation, and we're going to look at financial statements. But don't forget, we covered a lot of ground here, right? I know it's kind of the base ground, but we covered a lot, right? We looked at the business activities, right? Financing, investing, and operating. So you should know what each of those activities are. Okay, you should definitely know the forms that a business can take: sole proprietorship, partnership, corporation. You should also know the advantages of each of those. Okay, so when we come back in our next video, we're going to look at, I'm sorry, I don't know why I'm going through all these slides so fast. We're going to look at the accounting equation. Okay, so tune back in for that one.